It might be the reason why you lose money in Forex. It was the main reason why I was a failure in this Forex world, and it took me time before realizing it. This video is for any struggling trader. Now listen. So let's talk about the basic principles when it comes to inducement. So here you have your point of interest. Price approaches your point of interest, but reverses without making any contact, forming a new point of interest. So what would the retail trader or the uninformed trader do? They would try and take an entry at the newly formed point of interest just for price to take their entry out, go to the initial point of interest and reverse, forming your purge. And this entire swing that's approaching your point of interest but reverses without making any contact is called an inducement. Why is it called an inducement? Its sole purpose is to induce traders into taking a position. So let's break down inducement. You have your swing and you have your point of interest. So initially what an inducement is, say swing getting close to your point of interest, but then reacting away, what does that do? There are orders injected here that force price to sell. What does that mean? That means anybody that sold throughout this drop, their stop losses would be right here. So imagine their stop losses right above this swing. Because as price continued lower, as we know, in the lower time frames, price is not moving in a straight line. Price is moving in structure basis. So either a supply and demand structure, or it could move in a support and resistance structure. Either way, there are retail traders entering this trade as price is dropping. What price action would do next is come up, take the stop losses that are here, go to the initial point of interest, react from it, and continue the way that you intended here. So an inducement is basically a fake out. A fake out to entice traders into taking a trade before their initial trade. So let's talk about the double top and the double bottom inducement. You have your swing and this is your point of interest. Price come up for the initial inducement and comes back down. So you're like, okay, an inducement is occurring, but then instead of running through it, price came back to that inducement and rejected, forming your double top. And this is where the liquidity will be rested. So you know that price is incentivized to attack this level, to head to your point of interest. And that's what happens, forming your purge. So here's an example. Point of interest been formed. Now you can see price is forming the inducement. So let's talk about external to external inducement. You have your point of interest. Price approaching formed your high, now formed your low. So you're expecting price to continue driving to your point of interest. And that's obviously after understanding what inducement is, because now, your high has been taken. So you're thinking price is going to head straight for your point of interest, but instead, price goes the opposite direction. And now you think that this is a stop hunt, you think this is a purge, but in reality, this is just an inducement. This is external to external inducement. So both sides of the liquidity get taken. So here's an example of external to external inducement. Your point of interest been formed. You have your low taken. Now you have your high taken for price to head to the point of interest and continue lower. Let's cover external to external inducement. So you have your swing, and you have your point of interest. So now price forms the first swing. This would be your initial inducement. Then price comes back up and takes the swing out, but then comes back inside the range. So now you have retail traders thinking this is a change of character. So now that they think this is a change of character, they will think to get in a buy right here, just for price, go through their entry and come back into the range, taking both levels of liquidity out. This level and this level. So now this is one time when retail traders got taken out. So let's count. So now you have other retail traders saying, okay, I took a loss here, but maybe I can recover this loss by taking a sell right here, which would be your purge. Why is it the purge? Because it's a stop hunt. This high took out this liquidity. So a lot of traders think this is a stop hunt, and this is a smart money trap. So we had a retail trap here. Now we have a smart money trap here, just for price to take this entry out, take the liquidity, and head to the initial point of interest to continue down. So now you have two fake outs. So here's an example of a compression inducement. You have your point of interest. Price compresses before heading to your point of interest. What does compression mean? Compression is price moving in a structural basis from a supply to supply base or a demand to demand base. So here's an example of a compression inducement. Price starts cramping and moving in a tight range, but with a direction. Here is the main function of a compression inducement. As price forms complex pullbacks inside of this range should be your first swing. Now, it breaks structure right here. Smart money traders anticipate a order block continuation. So they get one. Now a structure broke again. They'll be like, okay, there's another order block, or maybe a mitigation block. So let's say it's a mitigation block somewhere here. So now price comes back, reacts from this level. Now it heads to your point of interest. So let's say certain traders don't notice this point of interest, and they're just focusing on the complex pullbacks, which is the lower time frames. They're focused on the lower time frames instead of the higher time frame structure of the market. So what they would do is they would anticipate another discount order block reversal here just for price to break it. And even if they were still holding trades here or holding trades here, it will take them all out. And that's because they failed to acknowledge the main point of interest. So now let's talk about internal liquidity inducement, which would be your FTB fail to break. You have your swing, which forms your point of interest. And now you have your first swing, which would be your inducement. That inducement forms a demand level. So now price reacts from that demand level to later on, come back to your point of interest, the liquidity inducement. Your point of interest, been formed. Price is reacting from that demand level, which was forced by the initial inducement. Now price is heading for your point of interest. So let's break down internal liquidity inducement. So say you have your swing right here, and this is your point of interest. So now price forms the first inducement, and then it comes back up, forming a what? A level of demand, which would be another point of interest, depends on what time frame you use. So what price would do come to this level and react? What happens when this reaction happens? When this reaction happens, money gets injected right here to push price up. When price does come back to this level, there is not enough orders to sustain another major push for price to go up. So price will, by design, go to the next level, where there is liquidity, which would be your initial point of interest for price to react from. So that's all for this video. I will see you in my next video.